Can start.
Yeah. Respected Chairman, respected Speaker of the Day, Sri Anjani Kumar Khetan sir, respected participants of our fellow professionals and the office, namaskaram to you all.
Namaste.
In the continuous professional development, our SIRC is giving a lot of scope, and in that process, today we have a program on Ind As 32, and this is about presentations, financials presentation. Am I right, sir? I think you have to watch me. These things have come only after I qualified. So, AS itself had come only after I qualified. So, these are all the new thing, and this Ind As test one, and we require now the presentations in Ind As. In most of the areas, I think by even MCA portal itself is prescribes only this. So we'll have to go by this. And in fact, we had a lot of in this time with regard to that while going through the accounts of the assets. Here is Mr. Anjani Kumar Khetan sir, and he is an associate member of ICAI with 23 years of post-qualification experience. Sir, still you are an associate member, sir?
Yes, I have not changed the profile from associate to fellow.
Yes. He is a renowned business experience in leadership roles with renowned business organizations, both in industry and in the one in Big Four accounting firms. In addition, Anjani, an associate member of ICAI and a licensed member of ICS, is currently based out of Bangalore and is working as a regional head in a finance company, MNC. And his core competence includes managing entire gamut of finance, treasury, taxation, both domestic and international, transfer pricing and corporate accounting, including compliances with US GAAP, IFRS, and Ind As. And is a visiting faculty for ICAI's training course on Ind As for the last 7 years. He is also a panel of shortlisted faculties by ICAI for GST, and is a diploma in international taxation, and he has contributed articles in various professional magazines brought out by ICAI, ICSI, and Karnataka State Chartered Accountants Association. Thank you, sir. We welcome you to this and the forum is yours, sir. Thank you, sir.
Thank you, sir. Thank you, sir. Thank you very much for your nice introduction. Okay, let me try sharing my screen, and if you can confirm that it is visible, then we can start the session formally. 1 second, let me just see. Now it is in the presentation mode. Is it,
yes,
is it visible?
Yes, sir. Visible, sir. Visible.
1 second. Okay. Yeah. Okay, so good evening, members. So today we have the topic Ind As 32, which deals with presentation of financial statements. We have 3 hours within which we need to cover this session. I hope that we should have sufficient time to cover this topic. When we talk about financial instruments standard, you will be curious to know that it is not any single standard. Rather, when we talk about financial instrument under Ind As, it broadly consists of these 3 standards: Ind As 32, Ind As 109, and Ind As 107. Now, they cover various different aspects related to financial instruments accounting. Our focus today is to look at the core requirements of Ind As 32. These 2 is something which is outside the scope of our discussion today. Now, interestingly, you would know that from a global IFRS perspective, this entire body of literature consisting of these three standards, the bare standard itself is close to 900 plus pages. Okay, so what we are looking at today is just a small bit of the entire literature covering Ind As 32, which is about 100 plus pages from an IFRS perspective, and under Ind As it is close to 50 pages of the accounting literature. So what happens? What are we targeting today? So in Ind As 32, what we will be seeing today is how the standard defines what is financial asset, what is financial liability, and how an equity has been defined under this standard. The core discussion in this standard is primarily focusing on how to classify a particular financial instrument as a liability or an equity. How do we make a distinction whether a particular financial instrument is a financial liability or an equity? This is the core of the discussion which we are going to have today, because that forms the core of Ind As 32. We will also see what are the accounting requirements when an entity issues what is called compound financial instrument. For example, you may have optionally convertible debentures. Now, the accounting requirement for such optionally convertible debentures, which are in the category of compound financial instrument, there is a very specific way in which they need to be accounted for. We will see with the numeric example in terms of how we go about recognizing those compound financial instruments. How do we measure? How do we account for them? And also two other topics which we will look at is in what circumstances an entity can offset financial assets against financial liabilities. Are there circumstances where they can be offset? If yes, what are the conditions and when it can be done? And lastly, what we will look at, what is the treasury shares and what is the accounting for such treasury shares held by the entity, which is not, treasury shares is nothing but your own equity shares. If you happen to buy back certain treasury shares or your own shares, how do you deal with that? How do you account for that? So this would be the broad area of our discussion today. Now, this I already covered. This is the discussion point in terms of what are the things which we'll be covering. Now, a couple of things which are not, which we did not see in the last slide is this. For example, apart from what I discussed on the earlier slide, we will also see that the standard talks about certain exceptions. What those exceptions are? Because of these exceptions, a financial instrument which otherwise meets the definition of a financial liability is considered not as a financial liability but as an equity. So what are those circumstances? We will see that these circumstances are exception to the general rule related to liability classification. And these exceptions are exceptions related to putable instruments and exceptions or the arising out of obligations which happen during the liquidation of an entity. We will see that. Apart from that, we will also see how Ind As 32 differs in terms of accounting related to foreign currency convertible bonds. I have included a numeric example so that we understand that if an Indian entity complying with Ind As requirements, if that entity happens to issue a foreign currency convertible bond, how the accounting for such foreign currency convertible bond needs to be accomplished under Ind As 32. Also, there may be certain financial instruments whose settlement is contingent upon certain events. If that happens, how do we deal with such contingency? This is also, that is something which we'll cover as part of the discussion today. So first thing first, let us see some of the key definitions. The first being, what is a financial instrument? Because this standard deals with presentation of financial instrument. So what is financial instrument? If you look at paragraph 11 of Ind As 32. Whenever you see an expression like this, anything which is after the decimal refers to the paragraph number. So in this example, or in this case, paragraph 11 of Ind As 32, it defines what is a financial instrument. And it says that a financial instrument is any contract that gives rise to, on the one leg, a financial asset for one of the entities to the contract, and in the second leg, for the second entity, it is either a financial liability or an equity. So net, it is a contractual arrangement which gives rise to financial asset for one of the entities or one of the parties to the contract, and simultaneously it gives rise to either the financial liability or the equity for the other party to the contract. Okay, that is one. Now, secondly, when we say contract, so what do you mean by contract? Because if something is not contractual, by definition, it is not a financial instrument. So if you see here in the context of Ind As 32, when we say that financial instrument is contractual, contract here refers to an agreement which has clear economic consequences, and the parties to the contract have little discretion to avoid, and the parties to the agreement have little discretion. The parties to the agreement have little discretion to avoid, because it is enforceable in law. And that's why contract is something which we need to look at. This definition of contract in the context of Ind As 32 is given by paragraph 13. So paragraph 13 says, when we say financial instrument is any contract, we mean that contract which on the one hand creates a financial asset, and on the other hand financial liability or equity for the other entity, it must give rise to clear economic consequences, and parties accordingly have little discretion to avoid the respective responsibilities arising out of that contract, because that contract is enforceable in the law. And as we know, under Indian context or the Indian contract law, contract need not be in writing. Even if there is an oral contract under the Indian Contract Act, even if it is oral, as long as it is enforceable in the eyes of the law, it is a contract. So what could be a simplistic example of a financial instrument? When we say financial instrument creates is a contract which gives rise to financial asset and correspondingly a liability or equity, simplest example is a debtors or account receivable. Now for me, if I have a debtors, the correspondingly for the counterparty or my customer, it is an account payable. So for me, it is a financial asset. But for the other party, the very same transaction is a financial liability. So this is the simplest example of what is a financial instrument. Because such accounts receivable or debtors, it gives financial asset for me, and correspondingly, it is a liability for the counterparty. Same way, let's say as an investor, I invest in the shares of Infosys Limited. Now, when I invest in the shares of Infosys Limited, for me as an investor, it is an asset. That equity instrument for me is an asset, financial asset. But the counterparty for Infosys, the very same equity instrument is a equity instrument. So another example of financial instrument could be where, let's say, I as an investor, I have invested in the shares of a particular entity. That's the way you need to look at the definition of financial instrument. Moving further, This I have already given that your financial instrument could be a financial asset, financial liability, or an equity. Some of the examples we looked at: the trade receivable, trade payable. Apart from that, financial asset could be cash, wherein the government agrees that yes, this will have the rupee, say 100 rupee note has its value, which will be honored by the government. Same way, from an investor's perspective, if I invest in bonds or deposits, I already gave an example of equity instrument. For me as an investor, it is a financial asset. But the very same bond or deposit, from the issuer's perspective, is a financial liability. And this equity instrument, from the issuer's perspective, is a equity. Same way, loan receivable for the lender is your financial asset, and the very same borrowing for the borrower is a liability. Okay, so this is nothing new, and these two aspects of financial liability, which is relating to compulsorily redeemable instruments. What happens? Let's say you have a compulsorily redeemable preference shares. Now these instruments, because they are compulsorily redeemable, the issuer need to pay cash at a subsequent point in time or some other financial asset to settle its obligation arising out of that particular redeemable instrument. That is also an example of a financial liability, because under that instrument, the issuer need to pay cash or some other financial asset. It has an obligation to pay cash or some other financial asset. In contrast, if you look at compulsorily convertible, not redeemable, convertible instruments, here the conversion will happen from financial liability into equity, no cash involved, unlike in case of redeemable instrument where the cash need to be paid. If you have a compulsorily convertible instrument, say you have a debentures which will be compulsorily converted after say 3 years into, let's say, a fixed number of shares. Let's say I say each debenture of 1,000 rupees will be converted into 10 shares of the company, and for such shares or such say instruments, dividend is discretionary. In that case, this is an example of an equity, because there is no obligation to pay cash or some other financial asset. It is just a merely conversion of liability into equity. And we will see in subsequent slide, there is a concept called fixed for fixed. In this case, here we are saying that 1,000 rupee worth of debentures will be converted into, let's say, 100 shares of the entity. So the conversion ratio is fixed at the date of issue. If this condition is met and there is no obligation to pay cash, it falls within the definition of equity that we will see in further detail as we go along in subsequent slides. Moving further, what is financial asset? Again, paragraph 11, we have seen some bit of it. It says financial asset means cash, equity instrument of another entity, which we have already seen, cash or bank. My investment, if I as an investor, I have invested in shares of say Infosys, that is also a financial asset from my perspective. Now, there are two limbs to this, 3A and 3B. There are two limbs to it. We will go one by one. The first limb is this, 3A. Financial asset is a contractual right to receive cash or some other financial asset. This is something which we saw. If you have a trade receivable, I have a debtor in my books. I have a contractual right to receive cash against that particular receivable or some other financial asset from my customer. So for me, I have a contractual right to receive cash, and therefore that becomes an asset for me. The very same debtor, there is a contractual obligation to pay cash by the customer. So from a customer's perspective, the customer has contractual obligation to pay. I have contractual right to receive cash. So for me, it's a financial asset, but for the counterparty, my customer, the very same receivable becomes a financial liability. So this is leg 3A. There is another leg of financial asset. This is leg 3B. What does it say? It says, paragraph 11 continues to say, financial asset is a contractual right to exchange financial asset or financial liability under potentially favorable conditions. What does it mean? Take a simple example. Let's say I have purchased certain options, call options. What happens in a call option? I have the right to purchase. Let's say I have a right to purchase 100. So let's say, okay, I have a right to purchase shares at the rate of rupees 100 of, let's say, Wipro under the call option. And this option is exercisable at any point in time for next 15 days. Now what happens? If during this 15 days period, if the share prices of Wipro share goes up and it becomes, let's say, 120, I have the right to purchase the shares at 100, which I can sell at 120. So I will make a profit of 20 rupees on each of such Wipro share. So this option contract which I purchased is potentially favorable to me on the date of settlement because I will earn 20 rupees of profit. So financial asset includes within its definition any contractual right, in my example, call option, the contractual right to exchange the financial asset or liability under potentially favorable condition, which is what is given here. Purchased call option or purchased put option, if they are in the money means what you pay and what you get, you are in a favorable position. Here you are paying 100 but getting 120. You are in a favorable position. It's a financial asset. If it is the reverse situation, no, okay, we will come to that when we look at the financial liability. So the financial asset, cash, equity instrument of another entity, right to receive cash, and right to exchange financial assets or liabilities under potentially favorable conditions. These are the four limbs. Apart from that, there is one more limb. This is this. That financial asset in certain situations, when certain contracts are settled in entity's own equity, that is also included within the definition of financial asset. This is something which we will look at later once we look at the definition of financial liability. There I'll give you example by which you will be able to understand this concept. For the time being, let us keep this question part or this particular discussion part. Moving further. Now let us see, have we understood whatever so far I have explained? Have we understood the concept to see whether a particular item listed on the slide is a financial asset or not? So in this case, first thing, let's say if you have a scenario where you have an investment, I as an investor, I have invested in a perpetual debt. Perpetual debt means the debt will remain in the books of the lender and there is no obligation to pay the cash back to me. But that perpetual debt carries interest at a fixed rate. Is it a financial asset? Yes, because the instrument contains the contractual right for me to receive the interest at the periodic intervals. How about investment in subsidiaries? Yes, investment in subsidiary is also a financial asset. However, there is a separate standard Ind As 110 dealing with consolidated financial statement. So the accounting for such investment in subsidiaries would be governed by Ind As 110, but yes, it is a financial asset. How about lease deposits? If you have taken, let's say, office premises on lease and paid deposits to the landlord, is it a financial asset? Yes, it is. The reason is because I, as a lessee, has the contractual right to get back the lease deposit after a certain period of time when the lease comes to an end. So this is a financial asset. Let us take these two examples. This will contrast what circumstances you will not consider that a particular instrument is a financial asset. Let's say I get advance from my customer. So this is the customer and I'm the service provider. I get an advance, but the advance can be used only to provide goods or services to the customer. No cash can be refunded back. So if advance is given for purchase of goods where no cash will be refunded back, it is not a financial asset. The reason is contractual right to receive cash or other financial asset. That condition is not met because in this transaction advance would be settled by issuing goods or services, not cash or other financial asset. So such advance given for the purchase of goods which will not be returned back is not a financial asset. How about prepaid expenses? Let's say you have a Mediclaim insurance premium. You have paid to the insurance company for 12 months period. Such prepaid expense, is it a financial asset? No, it is not. Same logic which we saw in the previous slide or the previous point is still holds good here also. What happens in the prepaid medical premium or the insurance premium or any prepaid expenses? You do not have the right to get back the cash or the financial asset. All you get from the service provider is the continued coverage for next 12 months. Just like goods is the services that is being provided to you over the next 12-month period. How about deferred tax asset or any other tax receivable or let's say ITC under GST? Are they be considered as financial asset? Here also the answer is no. Why so? Because if you go back to the definition of financial asset, it must be contractual. Tax asset or liability, in this case tax assets, DTA or ITC receivable, they do not arise from contract. They arise from the operation of the law, that they are driven by the legislative powers of the government. They are driven by law, not by contractual arrangement. And therefore, they do not meet the definition of financial instrument. So when something is not contractual, like your tax receipts, which you are expected to get, or the ITC receivable, they are not financial instruments. Of course, they are receivable, but they are not financial asset. USD INR option, you have purchased the option and you are holding it. Is it a financial asset? Yes, it will be a financial asset to the extent it is potentially favorable at the rate of settlement. If it is not, then it will not be a financial asset. As long as we saw the leg 3B, where you have, if the transaction can be settled in a favorable position, it is your financial asset. Gold and bullion, it is not a financial asset, though it may be highly liquid, no contractual right to receive cash or other financial instrument. Now it's a monologue, so I don't know whether any comment is there so far, sir. Anybody can say, or is this?
No, sir. As of now, there is no question. Something I'll just try to ask over chat. If there is any question, they'll post it and we'll take it up in the.
Yeah, maybe it will be helpful to. It will be helpful to understand if the participants are able to follow, if the speed is fine, just to ensure that it does not remain a monologue.
We'll check with them, and I'll try to unmute those who join through application, so they can unmute and speak if possible.
Okay.
Yeah. Thank you.
Okay. Okay. If something comes up, you let me know. I'm moving forward in the.
No, there is compliment that it's going on a nice pace and nice explanation.
Good. Okay. Now let us move and see what is a financial liability. Now, if you have understood financial asset, it's fairly easy to understand financial liability because it's just the reverse of it. So what is a financial liability? Financial liability, again, the definition comes from paragraph 11 of Ind As 32. And there are additional guidance given in application guidance number 3 to application guidance number 12, 3 to 12, which is given in the standard itself. So if you read both of them together, paragraph 11 read with application guidance number 3 to application guidance number 12, you will conclude that financial liability is just the reverse side of it. What we saw, it's a contractual obligation to deliver cash or other financial assets. In case of financial asset, it was contractual right to receive. Here, it is a contractual obligation to deliver cash or another financial instrument. Or second leg, contractual obligation to exchange financial asset or liability under potentially unfavorable condition, unlike the previous one where we say potentially favorable. Take the same example. We said call option, I have purchased for 100 rupees and the value now goes up to 120. Look at this transaction from the option writer's perspective. Now the option writer has agreed to deliver Wipro shares at the rate of 100 and the value has gone up to 120. So in this case, there is a 20, leave aside the premium related to the writing of the option. Let's not get into that complication. Conceptually, if you look at, there is 20 rupees of the loss which the option writer has in this transaction for each particular share, because the option writer has to go to the market and buy the shares at 120, and he will get only 100 rupees contractually because the option holder is entitled to get the shares at 100 rupees. So it is out of the money from the perspective of the option writer. So in this case, if the settlement happens, it is potentially unfavorable to the option writer. So this option contract becomes a financial liability for the option writer. And this is exactly what you see here. In the previous case, we said purchased call options or purchased put option. Here we are saying written call option or written put option. So if the option writer has a written call option and it goes in the other direction and creates a potentially loss situation, it is a financial liability for that particular option writer. Now let us see the concept of what I parked in the previous slide, this guy. Certain contracts settled in entities own equity instruments. It's a very simple concept, but perhaps the language used in the standard is very, very difficult to understand. So let me simplify. I'll come back to this slide. Let us simplify this and look at the next slide. Okay, I'll give you an example so that you understand. Let's say I'm an entity. I have issued a debenture of 100 rupees today. 100 rupees debenture I have issued. This debenture is repayable at the end of 3 years. What I tell to the counterparty is that I have a value of 100 rupees to be paid back to you, monetary value of the consideration. I have to pay back 100 rupees to you after 3 years. If I say today itself, to settle this obligation, I will issue you 10 of my equity shares at the end of 3 years. So what is happening in this case? The amount which is payable, 100 rupees, is known to you at day 1. And the number of shares, 10. is also known to you on the date the instruments is entered into. If that is the case, this is called fixed for fixed. You have a fixed monetary consideration for which fixed number of own equity shares are issued to discharge the obligation. So in this case, what will happen? To discharge 100 rupee worth of my liability, I will just be issuing 10 equity shares. Irrespective of the movement in the share price, I have contractually agreed that I will pay only 10 shares, I will give only 10 shares at the end of 3 years. If that is the case, though it is a debenture which will be settled at a subsequent point in time by way of equity being issued, this is considered as an equity instrument and not a liability, financial liability. The reason is, if both of these legs are fixed, under Ind As 32, fixed for fixed criteria is met, and then that instrument is classified as equity. I'll explain with numeric example. Just hold on for a second. You just understand the concept for the time being. Okay. Then any other combination which is not fixed and fixed in both the cases. Here, second scenario, fixed, variable, variable, fixed, variable, variable. If any of these happens, it is not an equity instrument, rather it will be financial liability. Okay. Under this one is important. I have not covered this because there is a gap difference versus Ind As and IFRS. Here you will see fixed is there. Technically, you would have expected that it becomes equity. That is only in the context of Ind As. Yes, that is correct. We will see this with the help of an example later, that under Ind As 32, there is a specific carve out for foreign currency convertible bond. What that carve out says, that if I as an Indian entity, I am applying Ind As, if I have issued foreign currency convertible bond, then irrespective of the currency in which I have issued. So generally, these will be issued, let's say in USD or Euro. So what happens? My interest obligation on the USD liability will be in USD. So if, let's say, if $100 worth of FCCB I have raised and it carries a 10% interest, my interest obligation is $10. Now to pay this $10, I have to look at what is the exchange rate of the dollar when I have the liability to pay the interest. Now interest will be paid, let's say at the end of year 1, 2, 3, 4. Each of these period, exchange rate will vary. So even though my dollar interest is $10, my rupee amount will differ depending upon what is the exchange rate on each of these dates. So technically it becomes variable. It is not fixed but variable, because in the INR context, in the INR terms, my monetary value of the consideration is not fixed, because $10 into the exchange rate will give different numbers. However, under Ind As, we have given a carve out wherein we say, no problem, even if that is the case, even if your rupee denominated liability would be fluctuating, don't worry, I will consider that it is an equity. And I'll explain this in detail with the help of a numeric example when we go to the FCCB related discussion. Net, what we are saying, if you look at financial liability versus equity, only when both the legs are fixed, that means the amount which I need to pay and the number of equity shares which I'm required to issue, if both are fixed, You are meeting fixed to fixed criteria, and that instrument is classified as equity. In all other circumstances, it will be financial liability. But from an Indian context perspective, in Ind As, there is a carve out for FCCB. That is something which we will see later. Moving further. Let us see. Now we talked about this guy. This we saw, right? Let me explain you. I've already explained to you with the help of that call option written. Let us see with a numeric example, some other case, how do we apply the concept of potentially unfavorable condition. See here. In this case, what is happening? That an entity City Corp has borrowed 10 lakhs at an interest rate of 12%. So your opening loan was 10 lakh rupees, and you have a 12% interest, which is 1,20,000. Loan has a term of 10 years, and interest is payable every year. So at the end of every year, you have to pay this 120 over the 10-year period, and at the end of year number 10, you repay the entire 10 lakhs. That's the contractual terms. Principal is repayable at the end of 10 years. This is the contractual terms. So technically, you start with 10 lakhs. 1,20,000 is your interest obligation. You have to pay 120. Your principal will remain at 10 lakh. Okay. But here is the additional input. It says the entity failed to pay interest in year number 4, 5, and 6. In these years, your liability was there, but you did not pay. Zero. As per the terms of the loan, unpaid interest. So if you have not paid, it will be added to the unpaid principal. So what happens in the year number 4? 120, you did not pay. So your liability increased from 10 lakhs to 11.2. Now, next year, 11.2 will be subjected to 12% interest. Your interest obligation for year number 5 is 1,34,400. No payout, further increases the principal. Likewise, at the end of year 6, you have outstanding principal plus accrued interest not paid equal to 14,04,928. What happens next? It says an agreement, because of these financial difficulties, an agreement for rescheduling the loan was agreed at the end of year 7. You are at year number 6. At the end of year 7, there's an agreement which has been reached for loan reschedulement. So at the end of year 7, this is just an agreement which you have done for rescheduling the agreement. And as per that loan reschedulement agreement, City Corp agreed to pay 18.25 lakhs at the end of this year. 18.25. Now, if you see, this is the contractual amount you have to pay, 18.25. As a loan settlement agreement, you have to pay 18.25 lakhs. But if the loan schedule would have run in a normal way, your outstanding principal along with unpaid interest would have been only 17,62,343. So to the extent of difference between two amounts, if you see, you are paying 18.25, which is against 17,62,342, which means you are paying more than what you would have otherwise paid if the loan would have continued its normal course. So 18.25 you are paying as a settlement, but your liability would have been only 17,62,342. So the difference between these two, 62,658, it is the additional amount which you are paying. This is the loss which you are getting due to reschedulement. It meets the criteria of exchange of financial liability at a potentially unfavorable terms. To the extent of this 62,000, you are at a disadvantageous position. You are at a loss. You are in a potentially unfavorable position to the extent of this 62,658. This is an example of a financial liability in leg number 3B, or what we said 2B, the previous one. Okay, so this is how you have to determine whether it is a financial liability at an unfavorable terms or not. Okay, this I have given the journal entry. You can look at it. Nothing much. It is already there. We have already seen the the calculation. This is just an entry. Let us see one more example. I have included a couple of more examples. CT Corp borrowed 10 lakhs. 10 lakhs was borrowed from ABSPL. Loan was raised. Okay. Both the parties entered into an agreement wherein CT Corp agrees to settle the loan against issue of certain number of equity shares whose fair value aggregate to 10 lakhs. Now what happens in this case? Read this very carefully. I have a liability to pay of 10 lakh rupees because that's the loan which I'll be paying. But what I'm saying, I will issue to settle this obligation, I will issue certain number of shares. I'm not saying how many. So it is not fixed. I will be issuing certain number of shares whose fair value aggregate to 10 lakhs. So if the fair value of each share is 1 rupee, I will issue 10 lakh shares. But for each share, if the fair value is 2 rupees, I'll be issuing only 5 lakh shares to settle my obligation. So here, fixed for fixed criteria is not met, because though the consideration of 10 lakhs is fixed, but the number of shares which are supposed to be issued to discharge that obligation of 10 lakhs, that is not fixed. It will vary depending upon whether the market price is 1 rupee or 2 rupees. So in this case, will you call that this instrument is a liability or an equity? Obviously, it's a liability, because fixed for fixed, if it is met, then only it is equity. Else, in all other circumstances, it is a financial liability. So in this case, it will be a financial liability. Fixed for fixed criteria is not met. Okay, let us see a couple of more examples. I think I have included a couple of more. Let us see this. Yeah, see here. What happens in this case? Here, the entity has issued 1 lakh zero coupon bonds. Zero coupon bonds means there's no coupon, but they will be repaid at the end of the year. There is in intervening period, there is no interest payout, with a face value of 10 lakh. Sorry, 10 rupees each, which means 1 lakh into 10 lakh is the face value of the zero coupon bonds which you have issued. As per the terms of the issue, City Corp is required to settle the bonds at the end of 3 years. You are issuing now. At the end of 3 years, you need to settle. Bonds issued. At the end of 3 years, you are settling. But unlike the previous example where the number of shares were not known, here it is known. It says by issuing 1,45,000 equity shares of rupees 10 each. So you know 1,45,000 into 10, 14,50,000 worth of shares you will be issuing. That you know on day one itself. So fixed for fixed criteria is met in this case. If fixed for fixed is met, it's an equity instrument. Fixed for fixed, met. So if you see here, it's a debt instrument which is settled by way of issue of equity of 14.5. This transaction, this zero coupon bond, though in legal form it is a debt obligation, it is a financial liability, but under Ind As, this zero coupon bond, which is to be settled by way of issue of fixed number of equity shares, will be accounted for as if it is an equity. So what the journal entries you will record? On the day this instrument is issued, you will receive bank 10 lakhs, which is the cash of this 10 lakh rupees, you will get it. You have a liability on day one, which is 14.5 lakhs. This 14.5 lakh is nothing but 1,45,000 shares into 10 each. What is the difference balance? 4.5 lakhs. Where will that go? That at the very beginning will go to the debit of share premium if it is available. If not, to general reserve or premium, depending upon what the Companies Act tells you. But the fact is the delta between 14.5 and 10 gets recognized as a debit to the share premium or P&L or general reserve, as the case may be. This is analogous to redemption premium. 4.5 lakhs is analogous to redemption premium. So you record this entry. In the intervening period, year number one, at the end of year one, end of year two, no entry required because no payout is happening. No journal entry will be required. at the end of year 3, what will happen? To settle this 10 lakhs, you will issue equity shares of 14.5. So what you will do? Here, if you see what I have created an account, I said zero coupon bond equity settled account. It's just a parking account. I will nullify this by debiting it. I'll say zero coupon bond equity settled debit by that 14.5, and I will issue equity shares to the extent of 14.5. So you can see that though it's an equity instrument, it is accounted as if it is a equity instrument because fixed for fixed criteria is met in this case. Okay, let us see. Okay, before we go to this, okay, let me complete this and then we will go to the audience. Okay, so financial liability, just as we saw in the previous case, let us look at. If you have a non-refundable advance which you have received against sale of government securities. If you remember in financial assets, we looked at prepaid expenses or advance against goods. Here, non-refundable advance, you will not refund the cash, but the cash will be utilized to issue government security. Is it a financial liability? Actually, it is. Yes. The reason is why? Because here, the instrument here has an obligation to deliver other financial asset, which is nothing but the government securities. Government security is also an other financial asset. So though there is no requirement to pay cash, this is not met, but this is met. And because of which it is a financial liability. But if there is a non-refundable advance against revenue or future supply of goods or service, then that is not a financial liability because it does not have an obligation to pay cash or any other financial asset, just like the case we saw in case of financial asset, prepaid, just like that. Financial guarantee is given. If I have given guarantee, is this a liability for me? Yes, it is a liability for me because I have a contractual obligation to pay cash. If the original lender fails to make the payment, the liability will devolve onto me and I as a guarantor have to pay cash. So contractual obligation to pay, though it is contingent upon future event of a default by the primary borrower, I still have an obligation to pay cash if that eventuality happens. So for an instrument to be classified as financial liability, it is not necessary that the entity should have an unconditional obligation to pay. It can be contingent upon those, in this case, the default by the parent or the main borrower. Tax liability we have seen, just like DTA, just like your ITC receivable, tax liability, not a financial liability, not arising out of contract, but because of the operation of the law. Okay, it will also not be a financial liability. Liability for damages under a lawsuit. If some damage is awarded and I pay in that case, that is also not a financial liability because it is not arising out of contract, but because of the intervention by the court. It is again not contractual, rather it is driven by the law. Okay, so this completes our discussion on financial liability, and the easy part is now let us look at equity. As we know, very simple definition of equity instrument in paragraph 11, read with application guidance 13 to 14J. It says simply an equity is any contract which evidences residual interest. We know what is equity. If you have an asset and you have a liability, this is the residual. This is nothing but equity. This is nothing but equity. So it's a very simplistic definition. Equity evidences residual interest, leftover interest in the assets of an entity after deducting all the liabilities. If you have this much of assets, this much of liabilities, whatever is left over after paying the liability, that residual interest is nothing but your equity. Nothing much. This we know about it. So there's nothing much to explain here. Let us see further. So this chart tells you all. This chart and the next slide, we will look at it. So what happens? for determining whether a particular instrument is a liability or an equity, what you need to ask? You ask these two questions. Is there an obligation? Is there a contractual obligation? Is there a contractual obligation to deliver cash or some other financial asset to another entity? If the answer is yes, or is there a contractual obligation to exchange financial asset or liability under conditions that are potentially unfavorable? If the answer is either of these answer is yes, then it's a liability, financial liability. If the answer is no, you still have to ask the second question, that whether that instrument is going to be settled by issue of own equity instruments. If the answer is yes, then look at whether fixed for fixed criteria is met. So own instrument settled by way of issuing equity instrument, fixed for fixed criteria met, it's an equity. But if fixed for fixed own equity instrument is not involved, then in that case it becomes a financial liability. So this is the flow chart you need to apply to determine whether a particular instrument is a financial liability or an equity. Of course, this is subject to these exceptions. This we will read in the subsequent slide. There are two major exceptions to this general classification criteria of equity versus liability, wherein the two exceptions are related to putable instruments and instruments which entitle the holder to a pro rata or proportionate share in the assets of the entity on liquidation. We will see this. Just hold on to your thoughts for the time being. All we are saying, this is the normal flow chart. It is subject to two exceptions that we will see in detail in subsequent slides. That is the thing which you need to keep in your mind. Okay, let us see this flow chart in a different way in the next slide also. So if you look at the standard, if you look at read the standard, the bare text of the standard, paragraph 11 of the standard gives the expanded definition of equity. When we say expanded definition of equity, this is what we saw in the previous slide, condition 1 and condition 2. This is condition 1, this is condition 2, and both need to be looked at, and this is the end condition. So if the issuer has no obligation to pay cash or some other financial asset, or the obligation is not in a potentially unfavorable condition, then it is not a financial liability. But if you meet this condition, you have to still look for whether that the instrument is settled by way of issuing the own equity shares. Is it being settled by issuing variable number of shares? So you know that you have 10 lakh rupees of liability, but do you know exactly how much shares will be issued? If it is fixed number of shares, it becomes equity. But if the number of shares to be issued is variable, then what is happening in reality is that you are using the shares as the currency and retaining with you the risks of the movement in the share price. So if the number of shares to be issued to discharge the obligation is not fixed but variable, then that is a financial liability. So fixed for fixed criteria met is an equity. If not met, it's a financial liability. And as I said, this is subject to these two exceptions. That is something is detailed next. We will see that. Let us see a couple of examples on equity classification. Here, City Corp invest in compulsorily convertible, not repayable or redeemable, is a convertible preference instrument at 1,000 rupees each at a premium of 990, which means face value is 10 rupees. As per the terms of the issue of the CCPS, each instrument is compulsorily convertible, not redeemable. No cash. It is convertible into one equity shares at the end of 5 years, which means number of shares to be exchanged is known day one. This instrument carry dividend at 12%. However, this dividend is payable only when it is declared by ABSPL, which means what? The entity for contractually is not obliged to declare dividend, but if it declares, it is payable. So there is no contractual obligation on the part of the entity to declare dividend. From a business perspective, whether we declare or not, that is not what we are looking at. But it is very much possible for the legal entity not to declare the dividend. So contractually, dividend is payable only when I declare it. But if I chose not to declare, there's no obligation to pay cash by way of dividend. So dividend payout is at the discretion of the entity. Now what happens? In any preference shares, you will have dividend and the repayment. Now dividend is discretionary. I may or may not pay. Convertible, no cash payout. It will be converted into equity. So whether this instrument is equity or liability, it is equity because there is no obligation to deliver cash or other financial asset. So from the perspective of the issuer entity, this is an equity, not a financial liability. Let's see further. Okay, now at this point in time, sir, if you can go back to the participants and try to see, are they following similar deposit with customs authorities? So deposit with customs authorities, yes, it will be repaid by them in cash at a point in time. So if that deposit is refundable, I got one question from the audience, so that is what I'm responding to. It says, deposit with customs authorities, are they financial asset? Yes, if those deposits are to be refunded back by the government authorities by way of cash, yes, it is a financial asset. So any specific other question which is there?
Yeah,
And maybe if you want
that was the one question, sir. That is MEA strips receivable from governments of financial asset. Similarly, deposit with custom authorities of financial assets. That is one question.
Yeah, so that scripts will be covered under government grant standard. So you know, once you see perhaps a discussion related to government grant, that point in time perhaps you should raise this question. And this deposit related thing I've already covered. Maybe at this point in time, you know, just check with the participants, are they following any you know, is the speed fine, anything, you know, because I just want to make sure that people are able to follow what we are talking. Okay. So
yes, already
any
you can
comment?
see that. Yeah, last time we received the speed is comfortable and they are able to understand. They can follow it up. So you can see it in the comment box also. There is one question, sir. In the meanwhile, I'll just.
Yeah, okay. Maybe at the time when we, if you want to pick up, it's just one question. If you want, we can take it now also. You just tell me what is the question.
Yeah, yeah. I'll just share my screen. So 1 minute.
Maybe you just speak out if you want to speak out. Okay.
Yeah, you can see my screen. The second question.
Yeah, yeah. Okay. Definition. What does this mean in the definition of equity, non-derivative? Okay. Okay, let me go back to this. Okay, you can remove this this particular thing. Let me explain that with the help of the slide because that is there. 1 second. Okay.
Can you share a screen? Yeah.
You are able to see my screen now?
No, not yet, sir.
Okay.
Is it shared? And now it's visible. Yeah, visible.
So the question is on this. Okay, so 1 second. Now I think it would have gone 1 minute. Let me move it. Yeah. So the question that was asked related to derivative and non-derivative. I don't know why this is going. 1 second. Yeah. So you read this like this. You know, you have already understood the concept of fixed for fixed. You read it like this. It says a contract that will be settled in entities own. Yeah. that will be settled, a contract that will be settled in entity's own equity instruments. It's a non-derivative, like a bond, debtors. So if you have such kind of a non-derivative for which the entity is obliged to deliver variable number of, so you have a 100 rupee of bonds for which variable number of shares is to be issued, it is a liability, financial liability. That is the way the first leg is defined. The second leg is, let's say you have optionally convertible debenture. Now, the option which is embedded in that optionally convertible debenture is a derivative. So now read it that way. A contract which is an optionally convertible debenture, that contract has a derivative, which is the option embedded in this contract, that will be settled other than by way of exchange of fixed amount of cash or other financial instrument for a fixed number of own equity shares. So in optionally convertible debenture case, which is a derivative, the option element is a derivative, that will be settled, that will not be settled by a fixed number of shares. So here also fixed for fixed is not met. So to the question, non-derivative, you can read it like bonds or debentures. Derivative, for the simplicity, you can understand or and conclude like options embedded in a optionally convertible debenture. That's the way you need to read this particular topic. Okay, let's move further. Now we look at, now that we have understood the three limbs of financial instrument, first we looked at what is financial instrument, then we looked at what are the categories like financial asset, financial liability, and equity. Now the next logical question is, okay, we have understood what is financial instrument, but what other aspects are there which we will say that they are not financial instrument? So the standard tells you that this we have also seen. If something is not contractual in nature, like your tax payments which we saw or tax receipts we saw, liabilities or asset not contractual, they are not financial instrument. If you are dealing with physical assets like inventory or property, plant and equipment, no cash, or financial asset, they are not financial instrument. Likewise, intangible assets, copyright, trademark, patents, they are not financial instrument. We have already seen prepaid, deferred revenue, they are not financial instrument. This is another important point. It says contracts to buy or sell non-financial items, say coffee beans. They are also generally not a financial instrument. However, there are certain exceptions. I will explain this. If you see, I have just put a hyperlink here. So I don't know whether a hyperlink works here to take the control of. Anyway, if hyperlink doesn't work, no worries. This is covered at a later point in time. There is a specific last section of today's topic is related to this. Suffice to know at this point in time, what we are saying is, if an entity enters into a contract to buy or sell non-financial item like coffee beans, this coffee bean can be used for, let's say, coffee manufacturing by the manufacturer. So this is like a raw material which is being taken for which the physical delivery will be taken, and it will be used for own internal purposes, something called own use. Then in that case, they are outside the scope of the definition of financial instrument. However, such contracts in certain circumstances, those are the exceptions, can also be financial instrument, and that is what we will see when we go to this section. At this point in time, what is not financial instrument? Assets and liabilities not contractual in nature, physical assets, intangible assets, prepaid, deferred revenue, and generally contracts to buy or sell non-financial assets generally are not financial instrument. Having said that, in certain situations, they can also be financial instrument. That is something which we will see in the very last section today. Moving further. Now we'll look at, as I told you, there are two exceptions to liability versus equity classification. What are those? If you see here, these are the two exceptions: putable instruments and obligation arising on liquidation. So what essentially the standard tells you, that some financial instruments that otherwise meet the definition of a financial liability will not be considered as a financial liability, rather they will be considered as an equity in certain exceptional situation, because those represent the residual interest in the net assets. Let me clear this. If you read it, it says some financial instruments which otherwise meet the definition of a financial liability will not be considered as financial liability, but will be classified as an equity because they represent residual interest in the net assets of the entity. And we have already seen the definition of equity. Equity is a residual interest. So in substance, if a particular financial instrument is residual in nature, it will be considered as an equity and not financial liability, and that's the reason it is an exception to the general rule. Okay, what are those two circumstances? These are those putable instruments and obligations arising on liquidation. We will explain this. Let us see next couple of slides that will explain this concept, and I'll give you some example also. First, let us see putable instrument. What is a putable instrument? Take a simple example. We'll go to the slide. Take a simple example of a mutual fund units. What happens? I have invested, let's say 10,000 rupees in fund A. Fund A's units, and for which, let's say 1,000 units at the rate of 10 rupees were issued to me. What happens? Let's say out of this 1,000 units, 200 units, after 6 months, I go to the fund and say, redeem my units. What am I doing with these 200 units? I am putting them to the mutual fund to say, please redeem and give me the cash. So that 200 units is nothing but an instrument which I have put back to the issuer, the mutual fund. I have put it back to the issuer to give me the cash by redeeming those units. They are putable instrument. But do you say that these units issued to the equity units, the units, that 1,000 units to a unit holder in an equity instrument, do you say that it is not an equity? No, of course it's an equity, because all the risk and reward of that fund still devolves and is on the unit holder. This is putable only in certain specific conditions. So let us see what the standard tells you. The standard tells you in paragraph 11, putable instrument simply means an instrument which you have put it back to the issuer for redemption. It is nothing but redemption of the instrument. In my example, units of the mutual fund. If you apply the general definition of a financial liability, what is financial liability? Obligation to deliver cash. In this case also, when units are being put back to the AMC or the mutual fund, there is an obligation to pay cash. So this otherwise meets the definition of financial liability. So putable instrument like the units of the mutual fund will generally be classified as financial liability because they have the obligation to pay cash. But because of the exceptions given in paragraph 16A and 16B, there are certain conditions. So in certain situations, these putable instruments, though they meet the definition of financial liability, are not considered as financial liability, but are considered as equity. What are those conditions? These are the 6 conditions. So the standard tells you that if you have a putable instrument, but that putable instrument meet these 6 conditions, cumulatively all 6 must be met. There are these 6 represent a very strict condition for equity classification and not financial liability. So an instrument which otherwise meets the definition of a financial liability, but if it meets all of these 6 conditions as given in paragraph 16A and 16B of Ind As 32, then such putable instruments on meeting these 6 criteria will be classified as equity and not financial liability by way of the exception given in the standard. What are these 6 conditions? Very simple and intuitive condition. We continue to understand the example of the units of the mutual fund. The putable instrument is classified as equity if the instrument entitles, that instrument means the units, entitles the unit holder to a pro rata share of entities' net assets. What the person will get 200 units into whatever the NAV on that date. So this what the unit holder is entitled to is a proportionate share of the net assets. The putable instrument is subordinate to all other classes of instrument. It is an equity scheme. Therefore, all other obligations must be first met. What the unit holder in the equity scheme will get is subordinate to all the other classes of instrument because they have a residual interest in the assets of the mutual fund. I'm giving an example of mutual fund so that you understand it better. All the instruments in this class have identical features, which means whether have 200 units or 2 lakh unit or whatever, all the unit holders have the similar, that the instruments, all the unit holders having the unit holding have, those units have the identical features. Obviously, if there are in the example, person having 1,000 units, there may be 20,000 more people who may have units. All of those are actually carry the similar identical features. No other feature of this instrument satisfy the definition of liability. What is the definition of financial liability? Obligation to pay cash or potentially unfavorable situation where the settlement is required to be done. Right? If no other feature of that instrument satisfies the definition of a financial liability, this is the 4th condition. Then total expected cash flows of these unit holdings is substantially based on the profits of the entity or the net assets of the entity or the change in the fair value of the net assets of the entity. Then this is considered as an equity. And the instrument does not include any contractual obligation to deliver cash. Because if the instrument has a contractual obligation to deliver cash, it becomes financial liability and not an equity. So if you look at all of these 6 conditions, what these conditions point to, it points to that by one way or the other, you try to make sure that this putable instrument actually has a residual interest only, because they are entitled to get only a pro rata share. They are subordinate to all other classes of investment. They have identical features, and the return is dependent upon the profits or the change in the net assets. If that be the case, they are considered as equity and not the financial liability. And this is what these 6 conditions which we listed here, I have plotted it in the next slide. If you see here, these are the 6 conditions. Just for the purpose of para-wise listing, I have given it. So these 5 conditions are given in paragraph 16A, and this is given in paragraph 16B, which we have already covered. Whatever 1 to 6 conditions which we saw in the last slide is something which I have listed it here one more time, just to make sure that you understand the genesis and the source of these conditions. It is covered in paragraph 16A and 16B. All these conditions cumulatively must be met for a putable instrument. So a putable instrument which meets all these cumulative conditions, all those 6 cumulative conditions, that will not be classified as a financial liability, but it will be an equity. Let us see the second exceptions in the next slide. The second exception, it is in a kind of an extension where it says where the entity has an obligation arising on liquidation. What is that? As the name suggests, that the obligation to pay cash is only when the company goes for liquidation. Otherwise, there is no obligation to pay cash. So, certain instruments create an obligation to pay cash only on liquidation of the entity. And such liquidation can be certain to occur and is outside the issuer's control. For example, if you have a limited or a defined purpose, a partnership, that let's say after you construct a bridge, after that this will be dissolved. That partnership will be dissolved. So such liquidation is certain to occur. The moment the bridge gets constructed, liquidation will happen. It is certain to occur. Timing you don't know what time it will happen. So such liquidation is certain to occur or is uncertain to occur and is at the option of the holder. They may say at any point in time by giving notice you can liquidate the entity. Let's say 1 month's notice. So at any point in time by giving 1 month notice, liquidate the entity. So that is uncertain to occur and is at the option of the holder. But in both the cases, the amount that will be paid is only when the liquidation of the entity happens. So as per the ordinary or the general meaning of financial liability, putable instrument and the obligation arising from on liquidation should be liability. Why so? In case even if there is an obligation to pay cash at the time of liquidation, what are you paying? You are essentially paying cash. So if you apply the general definition of financial liability, even for obligation arising on liquidation, you are paying cash at the time of liquidation. But the standard says no, if that obligation to pay cash arises only on liquidation, then there is an exception you can apply to this, subject to meeting certain conditions given in paragraph 16C and 16D. Remember, for putable instruments, the conditions for exemption was in paragraph 16A and 16B. For this, it is in 16C and 16D. Let us see what these conditions are. They are similar, conditions which we saw in 16A and 16B. That's why I copied the same table which we saw in the previous one and grayed out certain portions. So paragraph 16C and 16D has 1, 2, 3, 4, 5. This and this condition doesn't apply for 16C. So similar conditions which we saw in 16A and 16B, similar thing. So for obligation arising on liquidation, if these conditions which I have ticked, which we saw in the earlier slide also, if these are met, 3 plus 2, cumulatively 5 conditions met, then that obligation arising on liquidation will be classified as equity and not a liability, because that is arising only on liquidation and meeting all of these conditions. So equity versus liability classification, obligation arising on liquidation and putable instrument, they are the two exception to the general rule of liability classification, wherein obligation to pay cash generally would be financial liability, but not for these two circumstances. Okay, so this completes our discussion on exception to liability classification. Now that we have understood so far, just if you take back maybe after this slide on the timing of classification, we will take a short break of 5 minutes, a bio break, 1 minute. Okay, so what happens now? We have seen what is financial instrument, what I've seen what is the definition of financial asset, liability, equity, right? All of that we have seen. We have seen the exception also. Now the question is, okay, you have issued an instrument. At what point in time you will determine whether the instrument issued is a liability or equity? So what is the timing? At what point in time you will classify the instrument issued as a financial liability or equity? The answer is very simple. Let us see the next slide. The standard, what the standard tells you. It says at initial recognition. So the standard tells you the timing of the classification between equity and liability is at the time of initial recognition. And at the initial recognition, if you have determined that something is equity or a financial liability, that classification is never changed subsequently. Once classified as equity, always remains equity. Once classified as liability, always remains liability. That's the general rule under Ind As 32. So how to differentiate? Okay, let us conclude. I think this portion, it will be very good, since we are in the flow. Next couple of slides we will complete, and then we will take a break, because otherwise the flow will get disturbed. Okay, so what is the core principle one need to apply for the classification of liability versus equity? It's what we saw in the previous slide. The classification has to be done by the issuer at the time of initial recognition, and the basis of this classification between equity and liability should be on the basis of substance and not the legal form. Substance of the arrangement rather than the legal form. And according to the definition of financial asset, financial liability, and equity, which we already saw. So how do you go about recognizing a liability or equity? You go about classification at the time of initial recognition by looking at the substance of the agreement and not just the legal form, and by also taking into cognizance the definition which we saw in paragraph in earlier slides related to financial asset, liability, and equity. This is the rule, cardinal principle in terms of how you go about classifying liability versus equity. So for some financial instruments, although the legal form may be equity, take an example of preference shares. From an Indian context, under Indian GAAP, we always say preference share is an equity. So although the legal form may be equity, in substance, the arrangement is similar to liabilities. For example, if you have a preference share, it may display the characteristics of an equity and liability both, depending upon what is the contractual arrangement while you are issuing the preference shares. I have included 6-7 case studies. We will go with that subsequently. There is a whole section on preference shares we will discuss later. But what we are trying to say that the classification of liability versus equity should be by taking into cognizance the actual substance of the agreement and not just the legal form. So classification based on substance and the definition of the financial asset, liability, and equity. Is there a contractual obligation to transfer cash or other financial asset? If yes, it's a liability, else it's an equity. When you will do? At initial recognition. So legal form need not be the equal to substance. Legal form, though the legal form lead to substance, but it did not always be. Substance and legal form are generally consistent, but they are not always consistent. For example, in case of preference shares, we have to look at the contractual terms and agreement to see and really find out whether the preference shares is actually an equity or a liability. That is something which we will see after the break. Let us take a break. By my watch, it is 6:29. Let us take about 6 minutes of bio break. We will start the session at 6:35. Is that okay, sir? We'll start at 6:35 and we'll take about 6 minutes of bio break. Okay. Okay, I'll
Sir,
put
can
myself
we
on mute.
Yeah, sir, can we go for a break, sir, now? Yeah.
Yeah, that's what I said. So
Yeah.
by my watch, right now 6:30, maybe 5 minutes break we can take.
Yes,
6:35 we
sir.
can start?
In 5 minutes we'll resume. You let me know when you're ready. Okay, I'll just put my break slide
Yes, okay.
on that.
Thank
Yeah,
you.
I posted it. Thank you.
Yes. Can we start?
Yes, sir.
I see there is one question which is there. Maybe once you start, I'll deal
I'll
with that
just
question.
share that screen, sir. Maybe 1 minute, 1 minute. I'll just give
There's
that
only one
question.
question. There's only one question. I can read out that
Cryptocurrency
question.
for financial investment, right? That one. Yeah.
Are cryptocurrencies financial instrument? To me, they are not, because they do not meet the definition of financial asset. Okay, it's very simple, because none of the legs of the financial asset, which we show cash, so it is not a legal tender. Is it an equity instrument? Certainly not, of any other entity. The other two legs of the financial asset definition is not being met. So to me, it will not be a financial instrument. Okay, let us go back and let me try sharing my screen one more time. Is it visible, sir? The screen is visible now?
Visible, sir. Visible, please.
Okay.
Visible, sir. Yeah, please.
Okay, I'll move forward. Okay. Okay, this we have already seen, so substance over form. Now, if you see, if you try to summarize all what we spoke so far, what are the key characteristics when we talk about a financial liability? So financial liability leads to a situation where entity has obligation to pay cash. There may be mandatory redemption which is required for that instrument, which is not wholly within the control of the entity, and entity cannot avoid redemption and paying cash. Putable instruments normally will be liability, but on meeting the conditions of 16A and paragraph 16A, 16B, they will be equity. Liability only liability only a conditional right to avoid. If an entity has only a conditional right to avoid and not unconditional right to avoid, if I as an entity or the issuer on my own, I have a discretion to avoid the liability and pay cash, then it is no longer liability. But if I have a conditional right to avoid, then it is still my liability, because I can't unilaterally avoid the obligation to pay cash. Likewise, we saw if it is settled by way of issuing variable number of shares, fixed for fixed not met, it will be liability. And this contingent settlement provision is something which we'll look at in subsequent slide. Okay, so the key characteristics of liability is listed here. So if an entity does not have an unconditional right to avoid delivering cash or other financial asset to settle an existing contractual obligation, if the entity does not have such unconditional right, then that obligation is a financial liability and not equity. In contrast, when we talk about equity, there is no contractual obligation to pay cash or some other financial asset. Entity has discretion over the cash payment. It may or may not pay. The moment it has a discretion, it can avoid the cash payout. It is an equity. Fixed for fixed criteria, if it is met, it is an equity. Now, very important, look at this. The equity classification is not dependent upon the ability to make distribution. The fact that I have contractually, I am not required to pay dividend, that's fine. If I am not required contractually to pay dividend, it is an equity. I may have the ability, I may have profits, I may have reserves, I may have intention also to distribute the dividend. It does not make any difference when it comes to the distinction and the classification between liability and equity. What is most critical when you want to see whether an instrument is a liability or an equity, what you would need to look at contractually, what I am supposed to do. Forget about my ability. Forget about practically whether I will be required to pay a dividend or not. If I don't pay the dividend, my share prices will crash. Forget about it. Those are not relevant considerations. What you have to only look at is, by way of the written contract, am I supposed to pay cash? If yes, it's a liability, not an equity. Can I avoid my obligation? If I can avoid, it is a equity. If I cannot avoid, it's a liability. That's the way the classification goes. So the expectation of profits in future period, negative impact of not paying the dividend, all of these are irrelevant. They are not dependent. None of these factors are dependent on the classification. Likewise, look at the other way. Let me clear this. Look at this. Let's say I have a debenture. I need to pay contractually the debenture along with the interest to the debenture holders in 3 years' time. I don't have cash. Lack of access to funds. I don't have cash. Can I say that because I don't have cash, of course I'm supposed to pay, but I don't have cash? Can I say that it is not my liability? No. Lack of access to funds or need to obtain regulatory approval for some payment does not negate the fact that it remains your liability as long as the entity is contractually required to pay cash. And therefore, just because you don't have funds, just because the payout will require some government approval, does not change the character of the instrument. If contractually you are supposed to pay cash, subject to lesser government approval, subject to perhaps arranging some finances, still they will be classified as liability and not equity. That's the way you have to. So the moot point is you look at contractually what is the requirement. Let's build on this argument and see this slide also. This is building on what we just said in the previous slide. Some of the points are common. To reiterate, the classification between equity and financial liability is not impacted by history of declaring dividend or making distribution. Even if you have been declaring dividend in the past, but contractually, if you are not required to pay dividend, it will still be equity and not liability. An intention, you may have an intention to declare dividend. Possible negative impact we have seen. Expectation of profit we have seen. Yeah, an ability of the issuer to influence the amount of its profit is still doesn't matter. You look at the substance of what the contract is, look at the substance. In reality, what is it that I am issuing, and contractually what I'm supposed to pay. If contractually I'm not supposed to pay cash, it is my equity. But if I'm supposed to pay and I can't avoid my obligation, then it's a liability. Of course, two conditions or two exceptions we have already seen. But for those two exceptions, this is the general requirement. Now, preference shares, as I indicated, is on a different footing. Perhaps now we will see how you will classify preference shares. Decision tree, you can go through what we discussed, all in a pictorial form I have given. You can look at it. There's nothing much we can explain here. We have already seen that. Now look at preference shares. Now, this preference shares is a completely different ballgame because these shares can be issued in variety of combinations, and all the combinations may give different rights and obligations. So let us see, when it comes to preference share, how do we apply the liability versus equity classification? So the standard in general gives the guidance that preference shares need to be classified as a financial liability unless all these three conditions are met. In Indian GAAP, preference shares are always equity. But here under Ind As 32, it says if these three conditions are met, then only, and all, by the way, all the three conditions must be met. If all the three conditions are met, then it's a equity, else it's a financial liability. What are these three conditions? That the preference shares, in any preference shares, what obligations you will have? Dividend and repayment. So these are the three conditions. Preference shares are not redeemable on specific dates. No obligation to pay cash for redemption. Plus, preference shares are not redeemable at the option of the investor or the holder. They are not, which means a holder of the preference share, your preference shareholder cannot come and say, please redeem, because it is not at the option of the holder. If the preference shares are redeemable at the option of the entity, there's no obligation to pay cash because the entity may decide not to redeem. It's the option of the issuer, entity, not the holder. So a preference share is, if this condition is met, then it's a equity, which means preference shares are not redeemable at the option of the holder, shareholder cannot come and tell that at my option, please redeem it, which means no repayment obligation. Dividends payment on such preference are discretionary, which means even dividends are not contractually payable. What is the hallmark of equity? No obligation to pay cash. So if these three conditions are met, there's no obligation to pay cash either for dividend or for repayment. Contractually speaking, you may still declare dividend, but contractually you are not supposed to pay. If these three conditions are met, this preference share will be classified as equity. If any one of these conditions are not met, preference shares will be classified as equity. This is the principle you have to apply for when it comes to preference shares. So in respect of preference shares, you will classify as finance. Okay, so what happens? Let's say you have you have classified a particular preference shares as a financial liability because they do not meet the definition of, or do not meet these three conditions. Now tomorrow, so you have classified as financial liability at the initial recognition. Now later you declare dividend on such preference shares. So that dividend which you paid, is it your dividend per se, or is it your in the nature of interest? Because it's a liability. The standard tells you that if you have classified preference share as financial liability, the related dividend which you pay is also above the line, which is like an interest. Very difficult and different concept, but the standard is very clear that if you have classified preference shares as a liability, then the payout of dividend is also like an interest. So it will be above the line. Okay, that's the way the classification is required to be done under Ind As. Moving further, it's a simple thing which we if you see, we will go by that two requirement: dividend payout and repayment. If you see this, compulsorily redeemable preference shares, redeemable, not convertible, which means you have to pay cash. So if you have a compulsorily redeemable preference shares, it is a financial liability. But if you have a preference shares redeemable at the option of the holder, not the entity, option of the shareholder. So shareholder can come back to you and they may say, please redeem. Then the obligation cannot be avoided. Even this becomes the financial liability. So these two categories of preference shares, compulsory redeemable or redeemable at the option of the holder, is a liability. But let us look at the second bullet. Let me remove this. However, if dividend on such preference shares are payable at the option of the issuer, then such preference shares has an equity component and they are called compound financial instrument. I'll explain this concept by way of a numeric example as we go forward in the subsequent slide. But if there is an equity embedded option, it has the characteristics of both equity and liability. Then it becomes a compound instrument, and then you have to apply what is called split accounting. We will see that. Look at the other side of it. If these two type of preferences are not there, any other type of preferences, for example, if you have irredeemable preferences, repayment obligation not there, irredeemable, with a discretionary dividend, even dividend is also discretionary, or preference shares redeemable at the option of the entity issuer, they may avoid the payout of cash by deciding not to redeem it. If that be the case, they are equity because no obligation to pay cash. A variant, this we will look at split accounting as we go to the subsequent discussion. So if you summarize, I have given 4 or 5 combinations here. If you see, this slide captures these 4 or 5 combinations. Again, apply the same principle: dividend and repayment. First one, non-redeemable preference shares. So no cash payout. they are convertible into fixed number of equity shares. Fixed for fixed, met, and equity. Because no obligation to pay cash and fixed to fixed criteria is met. What about the second condition? Non-redeemable, no cash payout. Convertible into variable number of equity shares at the market price. Fixed for fixed, not met. It will be a liability, not an equity. Preference shares redeemable. Cash need to be paid at the option of the holder, shareholder. You can't avoid the liability if the holder wants to come to you and redeem, ask for redemption. It's a liability. But if that redemption is at the option of the entity or the issuer, then it's a liability, because the issuer may decide not to redeem it. There's no obligation to pay cash contractually. Optionally convertible preference shares. It's a compound financial instrument. We will see that. Likewise, redeemable preference shares with a discretionary dividend is also a compound financial instrument. We will see this in the next section. What is compound financial instrument and how do we do the accounting for this? Let's move further. These case studies, whatever we discussed, I have included 5-7 case studies. You can go through it. They are simple classification which we already discussed. These scenarios, I will pick up 1 or 2. Otherwise, you can go through it. There's nothing much to explain. I have already explained it. Let us see. Yeah, okay. Let us look at it. This one, not this one. Let's look at this one. Now, what happens in this case? Consider a scenario where City Corp, non-listed high growth company, has issued bonds which give the bondholders a right to redemption of the bonds at specific dates. So at specific dates, redemption is possible as a right of the bondholders. You have issued here, and these are the, let's say, the dates on which redemption is possible. Assume further that as per the terms of the issue, if the bondholder does not exercise this at these points in time, if the bondholder does not exercise the redemption right on these specific points in time, City Corp has the right, the entity now has the right to convert. If you do not redeem at the end of the period, I will convert into ordinary equity shares. Further, though the conversion terms are not decided, bondholders expect that the conversion will be more beneficial than redemption because it's a high growth company and the entity may go for IPO in the near future. This is all the expectation which the bondholder has. There is no contractual obligation. Accordingly, most debenture holders are interested to stay invested. They did not redeem it in these points in time. Hence, it is unlikely that the bondholders will exercise the redemption right. So in this case, do you say that it's a liability or an equity? It is, though the bondholders are not expected to exercise these. But this has no meaning at all, because what you have to look at is what is the contractual rights and obligations. Here, the entity does not have an unconditional right to avoid delivering cash. If suppose that the bondholder comes at this point in time and asks for the redemption, entity has no choice but to pay cash. So contractually, the entity cannot avoid the obligation of paying cash at these designated intervals, and because of which, because contractually it cannot avoid paying cash, it is classified as liability, even though the bondholders are not expected to exercise the redemption option. It doesn't matter, because what you have to look at is the contractual rights and obligations. Contractual rights and obligation is what you have to look at. Okay, so in this case, it will be classified as a financial liability. Let us see one more interesting example in the next slide. One second. I think I have one more. Yeah, let us see this. Here, City Corp has borrowed a sum of 50 million from the lender, ABSPL, for a period of 10 years. The term of the agreement provides settlement alternative. So this is the borrower, this is the lender. Sorry, this is the borrower, this is the lender. ABSPL has given money to City Corp. City Corp has borrowed 50 million for a period of 10 years. The terms of the agreement provide settlement alternative to CT Corp. So the borrower has settlement alternative, wherein at the end of the 10 years, it can either deliver a particular commercial building. So to pay or repay this 50 million, the borrower has a choice not to pay cash, but to pay a non, I would say, what do you call PP&E. Here, they can give up commercial building. So it is not a financial asset. Either deliver commercial building or repay the borrowing. So what happens after 10 years? The CT Corp, the borrower has a choice either to give the property, plant or equipment or to pay cash. Now, if you look at both these options are there, and these options are available to CT Corp. ABSPL cannot challenge it. So in that case, will it be classified as a liability or an equity? Very important. This is an exceptional situation covered in paragraph 20. I included this case study because generally people will tend to conclude that here CT Corp may decide not to pay cash. But there is a very specific clause or paragraph 20. Let us read it. Para 20 of Ind As 32 says that if an entity can avoid transfer of cash or other financial asset only by settling the liability through the transfer of a non-financial asset, that instrument is a financial liability. This is an aberration to the general concept because of the specific requirement given in paragraph 20. And why so? Because here the settlement of CT Corp has a settlement alternative whereby it can avoid transfer of cash by settling the liability through a non-financial asset, that is commercial building, right? So if the borrower has the settlement alternative, then paragraph 20 says very clearly that if you can avoid that payout of cash only by giving this non-financial asset, you will still need to classify as a financial liability and not equity. This is an aberration to the general principle, and that is the reason I thought, let me explain to you this concept which is coming straight from paragraph 20. Okay, now we will look at the compound finance instrument. Before we go to the slide, let me explain the concept first. Take an example of an optionally convertible preference share. So the debentures, let's say, optionally convertible debentures. Now, it's a general common sense, okay? What happens in an optionally convertible debentures? So you are now investing the money in debentures, and after a certain period of times, you can convert those debentures into equity. That's the whole concept of convertible debenture. And it is at the option of the holder. Now, it's a common sense that generally these instruments would be used when the investor believes that the equity will be much more profitable at the end of the term of the instrument. So what happens? Let's say if 3 years is the term of the optionally convertible debenture, what will happen? On day 0, the money will come to the issuer. Then at the end of year 1, 2, and 3, the entity will pay interest on these debentures. And then at the end of this year, 3rd year, basically you will be converting. So there will be no cash outgo here. And it's also a common observation that if this conversion option is not there, then the interest payout of a plain vanilla debenture without that option will always be higher. So for example, if this OCD, optionally convertible debenture, it gives the interest rate of 5% in this 3-year period. If this option is not there for a plain vanilla debenture, generally, let's say the interest rate will be 12%. Now, the difference between this 12% and 5% is nothing but the value of the option which this instrument carries. So what the standard tells you, that if you have such optionally convertible debentures, there is an option embedded in this contract to convert the debentures into equity. So what you have to do, you have to split the entire instrument into the liability component, financial liability, and equity, and apply what is called a split accounting. We will see this, how this is being done with the help of a numeric example. Let us see this. Theory I've already explained. So this is what the theory says, that if you have a compound financial instrument, you need to apply split accounting, and this value is, let's say, if the instrument has a value of 100, you apply the requirement of split accounting, and this 100 will be broken down into the liability component and equity component. How it was done, I will explain this with the help of a numeric example. But for simplicity, let's say it is 90 and 10. Then this 90 is considered as the liability component, and this 10 is a residual component, which is 100 minus 90. So what the standard tells you, that when you apply split accounting, first compute that of the total instrument, what is the liability component? In my example, 90. 100 minus 90, that is the residual equity component. So the issuer, in case of a compound instrument, when they are applying the split accounting, they need to first compute what is the liability component of such compound financial instrument. Determine that first. So the total value is 100 minus the liability component of 90. The balance 10 becomes the equity component. We will see the mechanics in terms of how it is being done by way of an example. But this 10 is never revisited. This 10 perpetually remains in your equity. Let us see this with the help of an example. How do you do that? Let's see here. What happens in this case? That Citicorp has issued 2,000 convertible debentures with a face value of 1,000 each, which means face value of 20 lakhs of these instruments you have issued, 20 lakhs. Debentures carry a coupon of 6% payable at the end of the year. So 1,20,000 is what is your annual interest coupon. This is the coupon. And it has a 3 years term. So after 3 years, you have an option to convert. The debentures are issued, when these debentures are issued, their coupon is only 6%, but the market interest rate for similar debentures, which does not have conversion option, is 9%. So because the debenture has an option embedded in it, the rate of interest is reduced from 9% in the market to 6% to give the benefit of conversion. So in this case, the coupon is based on what contractually you have agreed as per the terms of the contract. Continuing the same example here, so you are saying you have issued 20 lakh worth of debentures. They carry coupon of 6%, but the market rate of interest is 9%. For similar bonds, everything same, but there is no option, that there is no facility for conversion. So if you would have gone for a plain vanilla bond without the conversion option, you would have earned 9%. But because you have applied to go for the optionally convertible bond, in that case, your interest rate is reduced from 9% to 6% in this example. And these debentures are convertible, not redeemable, convertible at any point in time up to maturity into 250 equity shares. So in this case, if you see that, let me just go to the next slide. I'll explain the calculations. So what happens in this case? It is a 3-year, year 1, year 2, year 3, 3-year instrument, 20 lakhs into 6% coupon. 1,20,000 is your contractually agreed interest per year. 1,20,000, 1,20,000, 1,20,000 is what you have a liability from a coupon perspective. And if there was no optionally convertible option, what you would have done, you would have redeemed at the end at 20 lakhs, which is the amount which you raised. So this is a notional calculation to say, and this calculation tells you how do you compute the liability component. In my example, 100 is split into 90 and 10. What we are looking at in this slide, how do you compute this 90? So the 90 you will compute by looking at the contractual cash flows of a plain vanilla instrument considering coupon. So coupon will be 120, 120, 120. You would have repaid 20 lakhs as the repayment. So your total cash outflow would have been 1 lakh 20, 1 lakh 20 and 21 lakh 20, consisting of the principal of 20 lakhs and 1 lakh 20 of the interest. But to arrive at the liability component of 90 in my example, what you do, these cash flows, you discount at the market interest rate of 9%, not 6%. So if you apply this 9% discount rate, then you compute this, the value of this cash flow stream contractually agreed at 6% at a discount rate of market discount rate of 9% is only 18 lakh 48,122. And what you are getting is 20 lakhs. So the difference between this 20 lakhs and 1848 122, this is the residual. The difference between 20 lakhs minus this is nothing but the equity component. So in my example of 100 is split into 90 and 10. In this example, that 100 is replaced by 20 lakhs. So the 20 lakh worth of debenture will be split into liability of 1848 122 and equity of 151 878. What is 151 78? It is 20 lakhs minus derived liability component of 1848 122. So what is the journal entry we will record? This is the journal entry you will record on the issue of the debentures. On the issue of debentures, you will get cash of 20 lakhs. But the credit you are not putting into debentures, but you are splitting that credit into the two components which you computed here. So the credit will be to the liability of 1848 122 and equity of 151 878. This is called split accounting. So on the date of initial recognition, you look at the cash flow stream, discount it at the market rate of interest, arrive at the liability component. Let me clear it. It will be far more easier once again. So on the date of initial recognition, look at what your contractual cash flows are. Discount it at the market interest rate. Arrive at the liability component. From the total fair value, reduce the liability component. This residual becomes your equity component, and that is what you recorded. Cash of 20 lakhs. Credit liability of 1848, which you computed. Residual amount becomes the equity. Now, this what happens in the subsequent year? This 18. Let us see what happens in the. So your liability is 1848, which you have recorded. So let us see what you do the accounting in subsequent. This is only on initial recognition. What happens next? Now, it is like your debt amortization table. You start with your opening liability of 1848 122, which is nothing but the liability component, which we computed in the previous slide. Now, interest, though the coupon interest rate is 6%, for the purpose of Ind As 32 and interest expense in the P&L, you will not use the coupon of 6%, rather you will use the market interest rate of 9%. So using this market rate of interest, compute what would be your notional interest liability. So 9% of this 1848 122 is 166,331. This would be your P&L charge for interest and not coupon of 6% on 20 lakhs, 1 lakh 20. No, that is the cash payout. So opening liability of this much plus the accrued interest at the rate of 9% on the opening balance minus the cash payout contractually which you have paid coupon, that increases your liability, closing liability. If you see, closing liability has gone up from 1848 to 1894. The reason is you are adding more accrued interest at 9%, but paying only 120. What happens? This closing becomes the opening for next year. Again, 9% of this amount is 170,501. That is the accrued interest. This goes to P&L. You pay cash of 120. Your liability further goes up from 1894 to 1944. This again becomes your opening balance. And now 9% of this amount is 175. And then you make the full cash payout notionally of 120, which is nothing but your contractual amount of 21 lakh 20. What is 21 lakh 20? Your interest of 120 and 20 lakhs of your principal repayment. Liability is nullified to zero. So what happens? This is the way the split accounting is done, which means what happens in split accounting? At initial recognition, you are dividing the liability in my example of 100 into 90 and 10. And then you do the amortization by applying this table. So what do you see? Your interest charge by coupon was 1,02,000 into 3,60,000. But that's not your actual P&L charge. Your actual P&L charge for the interest will not be 3,60,000, but it will be 5,11,878. That's where you have to. That's how you have to do the accounting for the compound instrument. Now, if you just try to look at this, even from a contractual perspective, what you were supposed to pay was the 20 lakhs of repayment and 1.2 into 3.6 lakh of your interest. Totally 23,60,000. Ideally, you would have paid on a plain vanilla bond. Now, if you look at this amount is equal to the fair value of the liability component plus this interest of 5,11878. If you add these two, this is exactly equal to this. So the same result is being achieved, but you do the classification between liability and equity, and then your interest debits to the P&L will not be at the contractual rate, but at the market rate of interest of 9%. That's the way compound instruments are, financial instruments are recorded by applying the concept of split accounting. I mean, this is a flow chart. What we discussed is covered here. You can go through this. Now, as I mentioned at the beginning, there is a exception under Ind As related to foreign currency convertible bonds. Now, before we go to the slide, let me explain the concept. Let's say I am an Indian company. I have INR as my functional currency. I believe you guys know the concept of functional currency. Okay, so to very simplistically, I have INR as my currency which I use in my books of accounts. But foreign currency convertible bonds, I have raised the borrowings in say USD. I gave an example earlier also. $100 worth of borrowing I have taken, and let's say 10% is the interest rate. So my interest liability every year will be $10. But this $10 is denominated in the USD. So if there are 3 years of the term of this foreign currency convertible bond, every year I need to pay $10 of the interest. But the actual amount which I'll pay from an INR perspective is dependent upon what is the exchange rate in each of these 3 periods. So my actual rupee outgo for the interest will differ from year to year depending upon what is the exchange rate in these 3 periods. This is the exception which is given in the standard. Let us see what the standard tells you, what exception or carve out is given under Ind As related to FCCB. So as I explained, in case of a foreign currency convertible bond, so regular coupon and principal payout will happen, and it's a convertible bond, right? So equity, just like what we saw optionally convertible bond, the equity component is the option embedded in this to convert the bond into equity. Okay, so this is kind of just like what we saw split accounting. This is the liability component, this is the equity component. Liability component is nothing but the requirement to pay regular coupon. In my example, 10% of $100. So $10 is my regular coupon, principal repayment of $100. Okay. But where is the difference? What is the carve out? That is given in paragraph 11 of Ind As 32. You look at this, what it says. Paragraph 11 of Ind As 32 says, which is as a carve out, it says the equity conversion option, this guy, which is embedded in a foreign currency convertible bond to acquire a fixed number of entities' own equity shares, is an equity instrument if the exercise price is fixed in any currency and not INR, not necessary INR. Let us see this with the help of a numeric example. It will make things far more easier for you to understand. See here. In this case, what is happening? As on 1st January 2014, the company has City Corp with INR, is an Indian company. INR is its functional currency, but it has issued 1 lakh FCCVs, face value of USD $100 per bond, giving a total proceeds of 10 million. That's what is summarized here. 1 lakh bonds, each has a value of $100. 10 million is your face value of the FCCV. Foreign currency convertible bond, FCCV, carry an interest of 2% per annum. This is a contractual coupon on this FCCV and are to be redeemed or converted at the end of 3 years. Premium payable on redemption is 10%. So on this 10 million, you will be required to pay 10% premium also at the time of redemption. And each $100 face value of the bond is convertible at the holder's discretion at any time prior to this 3-year period. Is this you have issued on 1st of January 2014. So December 2014, 15, 16. So December 2016 is the 3-year period. Anytime up to this period, they are convertible at the holders discretion into 5 equity shares. So here the conversion amount is also given, that each bond will be converted into 5 equity instruments. On the date of issue, on 1st of January 2014, the prevailing market rate of similar bonds without conversion option, just like what we saw in the split accounting, they are entitled to only 2%, but market interest rate on a plain vanilla bond is 11%. Now there is an added complexity of the exchange rate. These are the exchange rates at various points in time. We will come back to this. Let us see, up till this point in time, whatever we saw the split accounting, same concept apply here. The only difference is that this is in USD and not in INR. So after you compute the USD numbers, you have to convert that USD number into INR by applying the relevant exchange rate. Let us see how that is being done. So if you see, this is the accounting which we saw. In this case, you have 3 years liability. You have a 10 million of the FCCV and contractual rate is 2%. Principal payout is with a premium of 10%. So 10 million plus 1 million is the premium. 11 million is the repayment of principal. And 2% of 10 million, 200K is your outflow in terms of the interest. But that interest is in USD. So 200 is the interest, and 11 million, which is 10 million plus 1 million of your repayment redemption premium, 11.2 million. This is my cash flow pattern. Though the contractual rate is 2%, I have to discount it at 11% the market rate of interest, as we saw in the previous example of split accounting. So if you apply this 11% rate, the discounted value of this cash flow is 85,31,848. But this amount is in USD. Okay, we will come back to the INR equivalent. So this 8.5 million, 31,848, this number, this is the fair value of the liability component on the date of recognition, but in USD terms. And the total fair value was 10 million. So the equity is the residual amount of 1.468152. Up till this point in time, this is nothing but what we have seen in the previous example on split accounting. Let me remove it. Let us see what changes now. Now, this amount is now becomes your opening liability. And that, as we saw in the previous example, by applying the market interest rate, you compute what your accrued interest would be, and then pay interest contractually. This is exactly what we did in the previous example, except that all the numbers are in USD and not in INR. So what happens in this case? That you have a FCCB of 10 million, which will require 1 million of repayment principal, your redemption premium, and it has 200K of annual interest. This is the cash flow. Okay. The liability component of this instrument as computed in USD is 8.53 million. Therefore, the equity component as a residual is 10 million minus 8.53 is 1.48 million. And then you apply this and come out with what would be your debt amortization table in USD, not in INR. Now what you will do, you will use these numbers and convert USD into INR. Let us see what is being done, and that you will do by applying the requirement of Ind As 21. What is Ind As 21? You would be knowing monetary item. Monetary item needs to be converted at the year-end rate. And if there's a P&L item, let's say your interest, it is for the entire year, that would be converted by using the average rate of exchange, average exchange rate during the year. Let us see how this is being done. Now, whatever we computed in the previous slide, was in USD. Now we are converting it into INR. So what will we do? Here, opening liability, accrued interest, interest paid, and closing liability. These four columns are nothing but whatever we computed in the last slide, this table. Opening liability, accrued interest, interest paid, closing liability. This number as it is, you are taking forward to the next slide and multiplying each of these numbers with the applicable exchange rate. What is the applicable exchange rate? This is this table. It is given in the example. It says on the date of issue, exchange rate was 80. Year-end rate has moved up from 80 to 85, but reduced from 85 to 83, and from 83 to went up to 90. And these are the average exchange rate during the respective years. So you will use this, but there is these exchange rates to convert those USD numbers into INR. How will you do that? You see here. So what will you do? Sorry. So what will you do? Whatever was the opening liability in USD, you will convert it into INR. Opening liability is at the end of the year. It is liability as at end of 31st December is respective period. So at the closing rate, you will apply the opening liability in USD into the rate, which is these rates. Closing exchange rate, as given in the example, is 80 at the beginning of the year, and then beginning of 2014, and then 80 moves to 85, 83, and 90. So opening liability, which you computed in the previous slide in USD, multiply by these rates, that will give you INR equivalent. When it comes to accrued interest, whatever is your USD accrued interest, which is these numbers, into the average exchange rate. Average exchange rate is given here. It is given in the example 82, 84, and 88. So the previous slide number in USD into the average exchange rate, because it's a P&L item. Accrued interest is for the entire year. That into 82. Likewise, interest paid. Interest you are paying at the end of the year. 1.2, the contractual payment. That is not there. You will not apply average. You will apply the closing exchange rate. What is the closing exchange rate? This 85, 83, and 90. That will give you the interest paid. Closing liability, again, based on the closing exchange rate. Now what happens? If you see, all of these numbers in these 4 columns, you have computed by applying the various exchange rates. And if you say opening liability plus accrued interest minus interest paid is equal to closing liability, if you look at closing, if you apply this formula, that this plus this minus this, then that amount by the formula driven, the calculation, let me clear this, will become, if you take this column, add accrued interest less paid, then this would be the resultant amount. But by conversion, the numbers are different. So by formula, the closing balance should have been 742 million, but your calculation says it is 787 million. So there is a difference, exchange difference, gain or loss in this case. The 45 million, your liability should have been 742 million, but by the conversion process, it is 787 million. So there is a loss, exchange loss of 45 million. This goes to P&L for this FCCB. Next year, your closing liability should have been 857 million, but by formula, it is 837 million. Now there is a reversal. The difference of these two is a credit to P&L. 19.56 million is the exchange difference for second year that will go in the reversal of P&L, because your liability actual is only 837 against what ought to be as 857. Likewise, this you will have to do the calculation, and the entire over the 3-year period, this amount of 98 million is recorded in the P&L. Why this is recorded in P&L? Because of the conversion of this FCCV required under Ind As 21. Okay, that's the way you have to do the apply the accounting for FCCV. Now, let's move to the another topic on contingent settlement provision and how that impacts the liability versus equity classification. So sometimes the payment or the settlement of a financial instrument can be dependent upon certain conditions being met. So if the payment or the settlement of the financial instrument is contingent upon certain conditions, that is called contingent settlement provision. If you have such a scenario, how do you classify the equity and liability? Let us see what the standard tells you. So the standard tells you that sometimes an issuer, the entity who is issuing the financial instrument, let's say debenture, entity is issuing debenture. The issuer may issue a financial instrument, debenture, wherein the manner of settlement, how do you settle this debenture? That how do you settle? Whether you settle by way of delivering cash or other financial asset, it depends upon certain certain uncertain future events, or on the outcome of uncertain circumstances which is beyond the control of both the issuer and the holder. Let's look at it this way. If I say that the redemption of the debentures in this example is dependent upon how the stock market moves, how the CPI or retail price index moves. So what happens in this case? The redemption methodology is dependent on certain uncertain future event, like movement in stock market, like movement in the inflation rate, or the outcome of these uncertain events is none of these are something which is controlled either by the issuer or by the holder. So there are conditions attached, but those conditions are not something which either the holder or the issuer can control. So in that case, why do we say that it is beyond the control of the holder? Because in this case, if the holder or the issuer, if they cannot determine or cannot control how the stock market behaves, which means the issuer does not have an unconditional right to avoid delivering cash or other financial asset if these conditions are met. So if these conditions are met, which you don't control, then it's a liability. So if you have a contingent settlement provision and the settlement depends on uncertain future event or the outcome of uncertain circumstances, then you will classify that instrument as liability. Why? Because you do not control, you do not have unconditional right to avoid the obligation. And if that is the case, if you cannot avoid the obligation, which means it's a liability, it's not an equity. The very definition is, if you have an obligation to pay cash which you cannot avoid, it's a liability. In this case, because of the fact that these are not within your control, if those events happen, you will still be required to pay cash, and that's why it's a liability. But this requirement is subject to certain exceptions. So in general requirement is that if the payout is contingent upon certain events, certain conditions which you do not control, classify as liability. But if there are certain exceptional conditions met, then you will not classify as liability but equity. What are those? Let us see the next slide. So for example, okay, before we go to that, let us see, this slide tells you whether these events which are listed here, is it within the control of the issuer? Do we say, for example, do we say that the settlement of the instrument is dependent upon commencement of a war? Now, how can an issuer decide when a war will commence? So it is outside the control of the issuer. Issue of a subordinated security which ranks equally or in priority. Of course, issue of securities is in the hands of the issuer. So this is something which the issuer controls. Now I read these two. Issue of an IPO prospectus prior to a particular date. Yes, that is possible, that issuer can control. But whether that IPO would be successful, that the issuer cannot determine. So issuer can only attempt a IPO, but whether the IPO is successful, that is not within the control of the issuer. The going for IPO, yes, it is in the control of the issuer, but whether the IPO is successful or not, that is not within the control of the issuer. Credit rating change, certainly not in the hands of the issuer, like that. So there are conditions which can be within the control of the issuer and which cannot be. Now we have seen that the liability classification you will do, which we saw in the previous slide. Liability classification you will do if these events are not in the control of the issuer or the holder. Let's see. Now, if you look at here, building on what we just discussed, where the event is beyond the control of the issuer and the holder, like the equity market movement, inflation rate, the issuer at initial recognition does not have unconditional right to avoid delivering cash, and hence normally it will be a financial liability. This that we saw in last to last slide. But then this is the exception. However, those conditions like stock market movement, inflation, if those are not genuine conditions, for example, I say, when we say not genuine means these conditions like movement in the price of, let's say, gold. Okay, so for example, if I say settlement in cash is required if the gold prices moves from $1,200 to say $5 lakh. Now, it is easier said, but in all probability, these events of price moving from $1,200 to $5 lakh is extremely rare to happen, highly abnormal or very unlikely to occur. If that happens, they are not genuine. So the condition, like if I say that the settlement is dependent upon movement in the gold prices from 1200 to 5 lakh. Yes, generally it will be classified as liability, but then this condition is not genuine because it is highly unlikely to occur. If that is the case, you will not classify as a liability, rather you will classify it as equity because it is not genuine. So though the contingency is there, the contingency itself is not genuine. And we have already seen if the liability is only in the time of liquidation, in that case, we have already seen that those are already the exceptions which we covered in paragraph 16A, B, C, and D. So if those requirements also are there, in that case, this liability classification will not apply. Net, if we were to summarize the last 2-3 slides, what are we saying? What we are saying is, if you have a financial instrument whose settlement depends on certain contingency, then because these contingencies are not in the control of the issuer or the holder, you classify the instrument as the liability, financial liability. But if this contingency itself is not genuine, then in that case, don't classify as liability, but as equity. That's the sum and substance of last 2-3 slides on contingent settlement provision. Let's see an example that will make things clear. So here, the entity CT Corp has issues an irredeemable cumulative convertible bond. So not redeemable, but cumulative convertible bond. Interest will be accumulated. Interest payout on such bond, however, is at the discretion of the borrower. However, the terms of the issue of the bond contains a clause which says, under this clause, the instrument, along with all the unpaid cumulative interest, will become mandatory payable. It is though it's an irredeemable instrument, but it says, but though it's an irredeemable bond, you are required to mandatorily pay if CT Corp, the entity, does not have an IPO by the end of the 4th year from the date of issue. Now what happens in this case? As I told you, attempting IPO is in the control of the entity, but whether the IPO is successful or not is not in the control of the entity. So this particular condition, in this case, that IPO should be successful. Company should go for IPO. This piece here, the entity cannot guarantee that there will be a successful IPO, which is within the country. It is not within the control of CT Corp, and because of which, because it is not within the control of the entity, you will classify it as a financial liability. So in this case, though there is a condition, but because of this condition is something which is not in the control of the entity, you will classify as a financial liability and not as equity. Now, this is a flow chart you can go through. This we have already seen. Now let us see what is treasury shares. It's a simple thing. If I have my shares, I buy some of my shares from the market. Okay, whichever way. If I am holding my own shares, that bought back shares which I bought back is called treasury shares. So which I'm the shares which my own shares which I'm holding, that is the treasury shares. Okay. How do we do the accounting for that? Let us see this. So the standard tells you what is treasury shares. This is what the definition of treasury shares. When an entity reacquires its own equity shares, such reacquired shares are called treasury shares. Paragraph 33 to 34 of the standard talks about this. So treasury shares are entity's own equity instruments which is held by the entity itself. The standard, these paragraphs tells you that if you are acquiring your own equity shares, you cannot recognize any gain or loss on such purchase, sale, issue, or cancellation of the own equity shares. They are all transactions within the owners itself. These are transfer between the owners. So any gain or loss which happens on such treasury shares is taken to equity, not to profit and loss account. See an example here. Consider a scenario where City Corp buy back 1 lakh of its own equity shares from the market at 5 rupees. So you are paying 5 lakh rupees and purchased 1 lakh of your own shares. These shares, these 1 lakh shares, are held as a treasury shares. Why they are being held? Because these shares will be used to satisfy the obligation to under the ESOP scheme. So the entity need to give the shares to its employees under the ESOP plan. So these 1 lakh shares which you have bought will be utilized to give the ESOPs to the employees. Now what happens? For the acquisition of this 1 lakh shares, what the entity will record in entry, it will pay 5 lakh of cash, and the debit will always be to the equity of 5 lakh, and there cannot be any gain or loss, because the standard very clearly tells you that if there is a gain or loss arising on account of these treasury shares, then they cannot be recorded to P&L, because this transaction represent transfer between the same owners. Accordingly, any consideration paid or received is recognized in equity, and that's why the journal entry will record on such treasury shares being purchased is that debit to equity, credit bank, what you actual cash amount, and nothing will go to profit and loss account. So treasury shares, they are the own shares of the entity. They are not regarded, not shown as assets in the balance sheet. They are being nullified. So they are deducted directly from equity. They are not shown as a asset. So it should not happen that in the balance sheet you will have, let's say, 5 lakh of your shares issued and 1 lakh you have bought. So it's not that you will show this as an asset on the liability. No, this 1 lakh need to be squared off, and the equity should be shown as only 4 lakh and not grossed up 5 lakh and 1 lakh. So not shown as assets, rather deducted directly from equity. And application guidance 36 says an entity's own equity shares is not recognized as a financial asset, irrespective of the reason for which you have reacquired. So therefore, the entry will always be debit equity, credit cash, and if you need to pay at a later point in time, payable. But that's the way you will do the entry. This you can go through. Okay, let us see this, the disclosure. This we have already, is just a flow chart which we have already seen. Now, what happens if the entity has purchased its own shares? Paragraph 34 of Ind As 32 says you need to disclose how your treasury shares operations are. So the amount of the treasury shares which you are holding, your own shares which you are holding, it needs to be disclosed separately, either in the balance sheet or in the notes. This requirement is given in paragraph 34, but the disclosure will be as required under Ind As 1, presentation of financial statement. So net, paragraph 34 says if you have treasury shares, disclose such treasury shares which you are holding as per the requirements in Ind As 1. And if these treasury shares have been acquired from a related party, then you give the disclosure as required under Ind As 24, related party disclosure, which means these are just the disclosure requirement. So paragraph 34 says that you have to give additional disclosure, and those disclosures has to be given as per Ind As 1 or Ind As 24. Ind As 24, if those equity instruments of the treasury shares have been acquired from related parties. If bought from the market, in that case, disclose in the either in the balance sheet or in the notes as required under Ind As 1. Now, next question. We have seen, right? Preference shares, we said, depending upon the terms, it can either be equity or your financial liability. Now, the question is, we have also seen what happens to the dividend which is paid on the such preference shares. If the preference shares is classified as financial liability, what happens to the dividend? Now, dividend, as I explained in one of the earlier slides, such dividend will also be like interest. So depending upon how you have classified an instrument, whether as equity or financial liability, the payout will also take the same characteristics. So for example, if you have an instrument which is classified as financial liability, then the distributions like dividend or interest or the transaction cost related to issue of such instrument will be recognized in profit and loss account because it's a financial liability. But if the very same preference shares is classified as an equity instrument, then dividend which you pay or the transaction cost you incur will be recognized in equity. So the treatment is dependent upon how you classify it. If you classify as equity, these two also go to equity. If you classify it as liability, it goes to profit loss account. Right? This is what is illustrated in the bottom, this example. If CT Corp has issued a non-redeemable preference shares, non-redeemable, no obligation to repay cash, and has discretionary dividend. So no obligation for repayment, no obligation for dividend, because dividend is also discretionary. So this will be equity. So this is an equity instrument, so any dividend paid on such instrument will also go to equity. But in contrast, if you have a compulsorily redeemable, not convertible, which means you have to pay cash, preference shares, this is a liability. So any dividend which you pay on such redeemable preference shares will go to profit loss, just like an interest. So the treatment of the dividend, treatment of the interest, or any other distribution which you make on the instrument is dependent upon what is the parent classification. If the classification is liability, it goes to P&L. If equity, it goes to equity. The last thing is offsetting. In certain situations, let's say, if an entity is dealing with another entity and it has a receivable from this entity and a payable also. So you have a receivable also and payable also. Both the cases there. Receivable for this entity becomes a financial asset. Payable for this entity is a financial liability. Now the question is that that I have the receivable and payable against the same entity. Can I offset each one of them? Let's say if the receivable was 100 and payable was 20, can I say that it is only 80 is something which is a net receivable? That is called offsetting. Can you do that offsetting? Let us see what the standard tells you. The standard tells you, paragraph 42 to 50, read with application guidance 38 to 39. It says, offsetting I already explained. Offsetting means presenting the liability and assets as one single number, which means 100 minus 20, don't show 120, just show a net amount 80. This is called offsetting. Can you do that? So offsetting can be done. You can show only 80, only in the circumstances when these two conditions are met. Which means what? Offsetting of financial asset and financial liability can happen if the entity has legally enforceable right to offset. If the entity has a right to offset that 20 against 100, and not only it has the right, it also intends to settle on a net basis, which means it doesn't want to receive 80, it doesn't want to receive 100 and pay 20, rather it wants to settle at 80 only. It intends to settle on a net basis of 80, or to realize the asset and settle the liability simultaneously. Okay, there are two things. Either you get 80, or on the same day you receive 100 and you pay 20. This also tantamounts to kind of a net settlement. So if an entity has both of these conditions met, which means the entity currently has a legally enforceable right to offset those receivable payable and intends to either settle at 80 or receive and pay simultaneously, then you can offset and show a single number. But if these conditions are not met, then you can't show net. You will show a receivable of 100 and you will show a payable of 20. You will not show net 80. Net 80 only when these conditions are satisfied. If these conditions are not satisfied, you will show it like this. That is the concept of offsetting. And offsetting, by the way, is not a choice. If these conditions are met, it is not a choice. If these conditions are met, they must be applied. Let's see an example here. Consider a scenario wherein, as of 31st March, the entity owes, so it has a payable of 20 million. As part of another contract, the entity owes reverse side a sum of 15 millions. So 20 million versus 15 million. Can you show it as a net 5 million? That's the question. Citicorp can do that, and in this example it says Citicorp has legal right to offset the assets and liabilities, but historically Citicorp have been settling 1 month after ABSPL settles the dues. What happens? You have this condition met because you have the right, but historically you are not settling at the same point in time. There is a time lag of 1 month. You first receive the amount and then you pay. So in that case, this condition is not met. In this example, only one of the condition is met. It is an AND condition. So in this fact pattern, though you are meeting this condition is not met, and that's why offsetting will not be allowed, because both the conditions cumulatively must be satisfied. The last item, contracts to buy or sell, non-financial item. I already gave an example. Generally, if you, let's say you are getting into a contract to buy these non-financial contracts or non-financial items like coffee beans. So paragraph 8 says contracts to buy or sell non-financial items like these, which are entered into for the purpose of delivery. So you are entering into a contract now. 3 months down the line, you have entered into a contract for the coffee beans. You say, you deliver the coffee beans to me in 3 months time, and I will use the coffee beans to manufacture coffee in my coffee plant or my manufacturing of the coffee powder. Then these kind of a contracts which are for own use, that is for your own use, they are not within the scope of financial instruments. So they are outside the scope of this standard. But then in these circumstances, if you have these contracts but you meet these conditions, then even these contracts will be considered as financial instruments. What are those conditions? Paragraph 9 says the following contracts, these 1, 2, 3, 4, they will be considered financial instruments. So what happens? Where the terms of the contract permit either party to settle the contract in cash or by exchanging financial instruments. So what we are saying, I have entered into the contract not for physical delivery, but let's say the price movement into this period is 10 rupees per kg. What the contract says in circumstances 1, okay, you give me 10 rupee difference and settle in cash. If that be the case, it is not for own use. You are like entering into a derivative which will be settled at the future period of, and you are settling net. if you have a change in the contractual terms wherein you can settle not by physical delivery, but by settling in cash, net cash settlement, then this contract is also a financial instrument. Second, when the ability to settle net in cash is not explicit in the contract, but the entity has the practice in the past of settling. So there is no contractual arrangement, but in the past, similar contracts have been settled that way only, which means in the past, you have historical trend, or you have historically the history wherein in the past entity have been settling in cash. Then that also will be within the scope of this standard. When for similar contracts, entity has the practice of taking delivery and then selling it within a very short period of time after the delivery. So you take the delivery and sell it, but not using it for your own purpose. This also means that you're kind of a net settlement, because what you are doing, you are taking delivery and selling it off. You are not using it for own purpose. You are not using it for your coffee manufacturing. Rather, you are using the physical delivery and then selling it, and derive the gain from that. That also would be financial instruments. When the non-financial item, that is the coffee beans, is readily convertible into cash. If all of these conditions are met in these circumstances, paragraph 9 says that these even non-financial items will be within the scope of this standard. Let's see an example. Here, Citicorp has entered into a contract to buy 100 metric ton of coffee beans at 1,000 for delivery in 12 months' time. On settlement date, market price moves to 1,500. So the question is whether own use exemption should it be, so whether this contract is within the scope of Ind As 32 or outside. In this case, if the contract cannot be settled in cash, which means you are not settling in cash, there's a difference. But because the contract is entered into for delivery in line with the entity's expected. So what is happening here? The contract has been entered into where you will take physical delivery of 1,000 of this 100 metric ton and use it in your business purposes. Then it's an own exemption will apply. And if that is the case, when you are entering into the transaction, you want to use in your own business process and don't want to settle in cash, then this transaction is not in the scope of Ind As 32. But if you want to settle in cash, then in that case, even this contract will become a subject matter of Ind As 32. So in this fact pattern, whether exemption applies, yes, is likely to apply, because they are going to take delivery and use it for own purpose. But if that is not the case, which means it is not used for own purposes, then in that case, it will be considered as a financial instrument. So with this, we come to an end of our session. Maybe at this point in time, let us see if there are any comments which are there. I would encourage the participants to perhaps give some feedback in terms of what do you think about today's session. Do you like it? Don't like it? Give some inputs so that it is helpful for me as a professional. Whether you like it, not like it, whatever, give some inputs. I don't see any question.
There is one question. I am sharing my screen, sir. Any different treatment for GDS like in case of foreign convertible bonds?
Yes. So see, I will not go into the specifics of GDS, but if the GDS has the same characteristics of foreign currency convertible bond as we discussed, because the structuring can be different. The principles which we discussed for FCCB, if any other instrument, including GDR, has similar features which we discussed in FCCB, then yes, you will apply same requirements as we discussed in FCCB. Yes.
Just one question, and we'll be sharing the feedback sheet along with the recordings and with your material, with your permissions to registered audience. And we'll be sharing the feedback with you over mail along with the comments that we receive from the sessions. And many ask for the PPTs. So we'll be sharing the same, right, sir? You can share it to the
I've already
participants.
shared it with the.
Yeah, we
Yes, you
have.
can share it. I've already shared it with the team.
Yeah, we have received it, sir. Just taking your consent
Yeah.
to share it with the participants, sir. And
Please go ahead and share it. No issues. Yeah.
thank you. We'll just wait 1 or 2 minutes to see if there is any other question that comes up, or else we'll wind up the session. So 1 minute.
Yeah. No problem. No problem.
Any other questions for this presentation and compliment for the pace and the thing that you're able to deliver, sir? And it seems there are no questions, sir. Maybe we'll share this recording along with the what we call the presentation to the audience in 1 or 2 days time. So once we receive the feedback, we'll be sharing it to your mails. Okay. Thank you so much for your time
No
spent
problem.
here, yes, sir. Sorry, 3 hours. And it seems our treasurer has connectivity issue. He has not joined now. So on behalf of him and
Okay.
our chairman and the secretary and office bearers in absence, we thank you so much for your time spent here for our members. Thank you so much.
No problem. Thank you. It's
Forward
always my pleasure. I hope I've been
Yes,
able
sir.
to add some value to the members' knowledge base. Thank you very much.
Absolutely, sir. And we'll like to have you in person in SIRC also, sir, in any time. Thank you so much, sir.
Certainly. 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 We will.
Thank you.
Thank you. Bye.